if you turn on literally any financial channel this morning, you are going to see just wall-to-wall coverage of central bank press conferences.
Right, it's nonstop.
Right. You'll see these panels of pundits parsing every single adjective a central banker uses, trying to divine what the global economy is going to do next. It's treated almost exactly like a daily weather report.
That is a perfect way to put it.
We all just stand around looking at the sky, waiting to see if it's going to rain interest rate cuts or, shine with economic growth. But relying on the weather report assumes the house you're standing in is actually structurally sound.
Which is a massive assumption right now.
Exactly, because if the foundation is cracking and the pipes are leaking, it really doesn't matter if it's partly cloudy outside. I mean, the basement is still going to flood.
The structural integrity of the house is entirely determined by the plumbing. And that financial plumbing, the overnight lending markets, reserve balances, the clearinghouses, all of that is completely invisible to the average person, until it backs up, of course.
Which brings us to our mission for today. This is Gilded News, and today we're going under the floor. While everyone watches the rate decision, we're watching the pipes.
I love that.
We are taking a deep dive into 3 incredibly dense, deliberately boring financial documents today. Because when you strip away the jargon from, say, the Federal Reserve's balance sheet or an OECD debt report, you uncover the actual mechanics driving your mortgage rate, your grocery bill, and your retirement account.
Because the mechanics are where the truth actually lives. The headlines might scream about this noble fight against inflation, but the operational documents from the New York Fed, they tell a completely different story about what is being prioritized this week.
So let's start right there with the Federal Reserve. For the last 3.5 years, the dominant financial narrative has been quantitative tightening, or QT.
Right.
The Fed was supposedly shrinking its balance sheet, vacuuming up all that pandemic-era cash. We watched it drop from nearly $9 trillion down to, about $6.6 trillion?
Yeah, right around 6.6.
They were letting bonds mature, taking the cash they received, and essentially destroying it to drain the system. But then very quietly, in December of 2025, that narrative completely fractured.
He completely broke down.
If you look at the New York Fed's implementation statement from December 10th and the FOMC minutes, they've flipped the switch. The Fed actually started buying bonds again.
This reversal is documented right out in the open, but it's hidden behind some absolute masterclass bureaucratic phrasing.
Oh, the jargon is incredible.
Right. They announced the commencement of something called Reserve Management Purchases, or RMPs. And the stated target is purchasing approximately $40 billion in Treasury bills every single month.
Wait, 40 billion?
$40 billion a month. And the physical impact on the system was immediate. By the week ending March 11th, the Fed's total assets jumped $17.45 billion in a single week.
Wow.
Yeah, landing at $6.46 trillion.
Okay, hold on. $40 billion a month in bond buying. Let me get this straight. When the Fed buys bonds, they're taking those bonds out of the market and replacing them with newly created cash, right?
Mechanically, yes. That is exactly what happened.
That is the literal definition of quantitative easing, like QE. That's the emergency bazooka they use to flood the economy with liquidity during a crisis. But they aren't calling it QE.
No, definitely not.
They're calling it reserve management purchases. I mean, this feels like they just slapped a really boring utility-grade sticker over a leaking pipe so nobody asks why there's suddenly water all over the floor.
That is exactly what they did. The phrasing is entirely a public relations mechanism. Look, quantitative easing carries an incredibly toxic political payload right now.
Oh, for sure.
People associate QE with the massive inflation spike of 2022. They associate it with Wall Street bailouts and just reckless monetary expansion. So by renaming the exact same mechanical process reserve management, well, it sounds prudent.
That sounds like a janitor.
Right. It sounds like a custodian just doing routine maintenance rather than a central bank injecting hundreds of billions of dollars of new liquidity into the financial system.
So if they were so committed to vacuuming money out of the system with QT, something must have fundamentally broken to force this pivot. I mean, they didn't just wake up in December and decide to rebrand QE just for fun.
No, they didn't. The warning lights in the overnight funding market started flashing red back in October 2025. That was when aggregate reserve balances, that's the cash banks keep parked at the Fed, dropped to $2.8 trillion.
Which is low.
It was the lowest level in nearly 3 years.
So let's break down the mechanics of that for a second, because reserve balances sound super abstract. At the end of every business day, banks have to settle up with each other.
Yep, the daily clearing.
Right, so if Bank A transferred millions to Bank B for customer transactions, Bank A needs the actual cash to make good on that. And if they don't have it, they have to borrow it from another bank overnight in the repo market. So the reserves are essentially the lubricant that makes that daily settlement possible.
And that lubricant is everything. If aggregate reserves fall too low, banks get nervous. They stop trusting that their competitors actually have enough cash, so they start hoarding their own reserves.
And then the pipes freeze.
Exactly. When banks stop lending to each other overnight, the cost to borrow that cash just skyrockets. We saw this happen dramatically back in September 2019 when the repo market completely seized up.
And if the overnight lending rate spikes, the Fed basically loses its grip on the steering wheel. I mean, the federal funds rate, which is the rate they announce on TV that dictates every other interest rate in the economy, that's just a target.
It's purely aspirational if they can't enforce it.
Right. If the actual overnight market runs out of cash, banks will charge each other whatever they want just to survive, completely ignoring the Fed's little target.
Which means the Fed basically ceases to be the entity setting interest rates. And they cannot, under any circumstances, let that happen. To maintain control, they have to ensure there is always an overabundance of cash in the pipes.
Hence the sudden desperate need for $40 billion a month in reserve management purchases.
Exactly. And the knock-on effects for the bond market are just massive. Bank of America's internal projections estimate $380 billion in these RMPs for 2026 alone.
$380 billion. That is not a small plumbing fix.
No, it's not. They calculate that this structural bid from the Fed will push the yield on the 10-year Treasury down by 20 to 30 basis points.
Because when the biggest buyer in the world steps into the market and demands billions in Treasury bills, the price of those bills obviously goes up.
Basic supply and demand.
And because bond prices and yields move inversely, the yield, which is the interest rate the government actually has to pay, goes down. So the Fed is artificially suppressing borrowing costs.
That's the magic trick.
It's wild. During a crisis, they announce bond buying to calm the public. Today, Chair Powell claims this is solely a technical adjustment to maintain ample reserves. But the bank analysts aren't fooled at all. They're telling their clients this is a massive tailwind for bond prices.
Because the institutional investors understand the plumbing. They do not care what the label on the pipe says. They only care about the direction of the water.
Yeah.
And for anyone listening wanting to track the flow themselves, you really don't need a Bloomberg terminal. The Federal Reserve publishes a document called the H12 4.1 release every Thursday at 4:30 p.m. Eastern. It's just a weekly snapshot of their balance sheet.
But where specifically on that document should you look? Because, I mean, it's just a massive wall of numbers.
Oh, it's terrible to read. But go straight to table number 1 and look at the line item for U.S. Treasury securities. You can track the week-over-week change right there.
Okay. Simple enough?
Right. The Fed initially projected a steady state of 20 to 25 billion a month after April. If you look at the H4.1 through the spring and see that $40 billion pace holding steady, you are watching a temporary plumbing fix morph into a permanent fixture of our financial architecture.
But tracing this plumbing leads to an even bigger structural question. Why is the system suddenly so incredibly thirsty for this liquidity? Like, why are reserves draining so fast that the Fed is forced to step in as a buyer of last resort?
Because the global government sector is preparing to open the floodgates.
Right. It's the supply side of the equation.
Exactly, and the supply side is staggering. On March 4th, the OECD published their Global Debt Report for 2026. Their baseline projection is that governments and corporations will need to borrow $29 trillion from the markets this year alone.
$29 trillion.
Yeah. That is up from $27 trillion last year and $25 trillion the year before. We are looking at a 17% increase in borrowing volume in just a 24-month window. Across the OECD, outstanding sovereign debt is hitting $61 trillion.
See, $29 trillion. Numbers that large just tend to lose all meaning for people. I mean, the financial media treats a phrase like $29 trillion the same way a meteorologist says partly cloudy.
It just becomes background noise.
Yeah, but think about the physical reality of that borrowing. When a government issues a bond, they're asking for cash. That cash doesn't just magically materialize out of thin air. It comes from a finite global pool of savings.
Right, pension funds, mutual funds, foreign governments.
Exactly. So if the sovereign governments of the world are dipping their giant buckets into that pool to extract $29 trillion, there is significantly less water left for anyone else.
The technical term for that is crowding out. When you go to a bank to get a mortgage, or when a mid-sized company tries to issue corporate bonds to build a new factory, you aren't just competing with the business across town for that capital.
No, you're competing against countries.
You are actively competing against the United States Treasury, the UK government, the European Union. Because sovereign debt is generally considered risk-free, investors will obviously buy it first. So to convince an investor to lend to your factory instead of the government, you have to offer a significantly higher interest rate.
So the sheer volume of government borrowing physically forces the cost of living and the cost of doing business higher for the everyday person. And the timing here is just brutal.
It really is.
We're seeing this historic debt issuance during an era where central banks claim they were keeping rates high to fight inflation. But higher rates mean the interest payments on that $61 trillion debt mountain are just exploding.
The UK's Office for Budget Responsibility, the OBR, released their March 2026 fiscal outlook, and it perfectly illustrates this trap. UK public sector debt as a share of GDP has nearly doubled the average of advanced economies.
Big bubble.
Doubled. A massive chunk of their tax revenue is now just servicing the interest on past borrowing, leaving almost nothing for productive economic investment. Their GDP growth forecast was just downgraded to a dismal 1.1%.
1.1, wow.
Yeah, the debt burden has become an anchor, dragging the real economy to a standstill.
Which brings us to arguably the most critical realization of this entire deep dive. If these economies are stalling, but their governments are structurally locked into borrowing trillions just to fund social programs, pensions, and defense, who's going to buy all this debt?
That is the trillion-dollar question.
Right. If the global pool of savings is tapped out, the bond auctions will just fail.
And the International Monetary Fund highlighted this exact vulnerability in Working Paper 2642, which was published just weeks ago. They modeled sovereign debt sustainability with a specific focus on nations driven by wealth redistribution.
What did they find?
The data shows that governments borrowing heavily to fund domestic social redistribution are the most exposed to something called financial autarky.
Financial autarky, meaning they basically get completely cut off from international credit markets. The global credit card gets declined.
Exactly. When international investors realize a country's economic growth cannot possibly generate the tax revenue needed to pay back the principal, they just stop showing up to the bond auctions.
And then what happens?
Well, once a nation enters financial autarky, they have to fund their operations entirely through domestic taxation, which usually crushes whatever is left of the private sector.
And this connects segment 1 to segment 2 perfectly. These governments cannot afford for the bond market to reject their debt. So the Fed's reserve management purchases are not just some technical tweak to overnight bank reserves.
Not at all.
They are the invisible bailout for this $29 trillion flood. The sovereign debt machine literally requires loose plumbing to function.
It has to have it.
If central banks aren't in the background quietly absorbing the supply, the sheer weight of the issuance breaks the financial system. They are acting as the buyer of last resort while looking us dead in the eye and claiming they're fighting inflation.
The math leaves them absolutely no alternative. And for you listening, to verify if this crowding out is actually choking the private sector, there is a specific metric you need to watch.
What is it?
You look at the spread between sovereign bond yields and high-quality corporate bond yields. In a healthy market, corporations pay a premium over the government because they carry default risk, right?
Right.
If you see that spread compressing, meaning the government is paying interest rates nearly as high as a corporation, it signals that the volume of sovereign borrowing is so overwhelming that it is vacuuming up all available capital.
Okay, so the pipes are flooding with $29 trillion in new debt, and the central banks are quietly pumping in synthetic liquidity to keep the system from cracking. But here's the ultimate question for everyone listening. How do we know when this hitter pressure in the pipes is going to burst up through the floorboards and hit your wallet at the grocery store?
You have to check the meter.
Right. If the system is running this hot, how do we track the inflation before it becomes front-page news?
We check the upstream meter, and that meter is the Producer Price Index, or PPI, which the Bureau of Labor Statistics released for February this morning. Look, everyone knows the Consumer Price Index, the CPI.
Yeah, it's the rock star of financial news.
Exactly. But CPI is a lagging indicator. It tells you what already happened at the retail register. PPI measures the wholesale costs. It tracks what the manufacturer pays for raw materials, transportation, and labor on the factory floor long before the finished product hits the shelf.
So we spend all our time waiting for the CPI thunder to rattle the windows. But PPI is the lightning flash, The storm is actually already overhead. We're just waiting for the sound to catch up.
That is exactly how you should think about it. And the mechanics of that delay come down to margin compression.
Walk us through that.
Imagine a manufacturer making automotive parts. Suddenly, their cost for steel and energy spikes. They don't immediately reprint their catalogs and raise prices on their retail customers the very next day.
Right, that would upset buyers.
Exactly. So they absorb the cost, they take a hit to their profit margins to maintain their market share and stay competitive.
They just eat the losses, hoping the price spike is temporary. But if the costs stay elevated for, 2, 3, 4 months, eventually that margin gets too tight.
The math stops working.
Right. The owner realizes they're going to go bankrupt if they don't adjust, so they finally pass the higher costs downstream to the distributor, who then passes it to the consumer.
And that transmission mechanism usually takes 2 to 4 months, which is why the January PPI data was a massive red flag. Final demand jumped 0.5% month over month. The core services component surged 0.8%, which is the fastest acceleration since July 2025.
And year over year.
Year over year, the index hit 2.9%. The pipeline is running incredibly hot right now.
And there's a unique structural quirk with this specific data set that makes it even more volatile, isn't there?
Oh, yeah.
The U.S. government shutdown back in October and November of 2025 severely disrupted the BLS data collection. The survey transmissions were delayed, meaning the current data quality is overlapping with the early days of recent global supply chain disruptions. I mean, the February release had to be practically reconstructed from scratch.
And that data noise makes trend identification really difficult, but honestly, it doesn't obscure the $100 oil elephant in the room.
Oh, let's talk about the oil.
The terrifying part of that hot January PPI report is that the energy component actually fell by 2.7%.
Wait, energy fell in January, but global crude oil just crossed $100 a barrel.
Right, but the January data was captured just before energy prices mathematically mask just how violently the services sector was inflating.
So the overall number looked bad, but the underlying reality was actually far worse.
Much worse. But the February data dropping today, that report captures 6 full weeks of crude oil trading at or above $100 a barrel.
So if the energy component flips from a negative drag to a massive positive driver, and the services component stays remotely as hot as it was, you have a double-barreled inflation shock sitting right there in the wholesale pipeline.
The entire cost structure of the global supply chain changes. The media obsession with CPI creates this massive blind spot. By the time the evening news reports that consumer inflation is reaccelerating, the narrative is entirely stale.
It's old news.
Exactly. The factory floors have already been paying those prices for a fiscal quarter. PPI gives you the actual truth of the current operational environment.
So here is how you use this information. When you look at the PPI drop today, ignore the broad headline number that gets tweeted out first. Dig into the cross-sections. You are looking specifically at the final demand energy component and the core services index.
Those are the key drivers.
If both of those line items are accelerating simultaneously, you can mathematically guarantee what the CPI headlines are going to say in April and May. You aren't reacting to the inflation shock at that point. You are mapping it months in advance.
Because anticipation is the entire advantage. Understanding the 2 to 4 month lag allows you to position yourself long before the consumer panic sets in.
So pulling this entire deep dive together, it paints a pretty wild picture of the actual global engine room. We have the Federal Reserve using linguistic gymnastics to hide $40 billion a month in bond buying just to ensure the overnight banking pipes don't run dry. And they have to do this because global governments are normalizing the extraction of $29 trillion from the global economy, which forces central banks to provide synthetic liquidity so the bond market doesn't just collapse under the weight.
It's all connected.
And simultaneously, the PPI meter's grinding up to show us exactly how these massive capital distortions, combined with $100 oil, are going to shatter profit margins and drive consumer prices even higher.
It proves that you just cannot isolate these systems. Sovereign debt issuance forces monetary intervention. That monetary intervention alters bank liquidity, and global commodity shocks pressure the producers. The plumbing connects absolutely everything.
It really does. Look, if you found today's mechanics fascinating, you definitely need to be here for our next deep dive on Thursday. We are walking into a quadruple central bank decision day.
It's going to be chaos.
Within a matter of hours, the Bank of Japan, the European Central Bank, the Bank of England, and the Swiss National Bank are all announcing their policy decisions. It's going to be a real-time stress test of the exact liquidity constraints we mapped out today. Plus, we'll be dissecting the fallout from today's actual PPI numbers.
Yeah, having four major systemic nodes adjust their values on the exact same day is incredibly rare. The cross-border capital flows are going to be extremely volatile.
You won't want to miss that breakdown.
Mm-hmm.
Make sure you follow our primary account on X at Real Gilded News. We post the source documents, the actual H.4.1 releases, the IMF working papers, and the daily clips tracking all the mechanics we discuss here.
Because reading the primary source material is really the only way to bypass the punditry.
Absolutely. Before we go, I want to leave you with one final thought to turn over in your head.
Mhm.
We spent this entire show looking at how advanced economies like the US and the UK are aggressively managing their financial plumbing just to absorb $29 trillion in debt. But think about the rest of the
The
world.
periphery.
Yeah. If the United States is offering risk-free yields and sucking up every available dollar of global savings just to fund its own deficits, what happens to emerging markets? What happens to a developing nation in South America or Southeast Asia that desperately needs foreign capital to build electrical grids or hospitals?
They get completely shut out.
Right. If the advanced economies vacuum up all the liquidity just to keep their own leaking pipes from bursting, the developing world gets entirely starved of capital. We might be looking at a future where the financial plumbing doesn't just flood the basement, it completely drains the entire neighborhood. We'll see you on Thursday.